Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, the U.S. jobs report just landed, and it caught a lot of people off guard. What stood out most to you?
Yes, it really was a jolt. Non-farm payrolls came in at 147,000, well ahead of expectations. That alone was enough to set off alarms in the bond market, but the real kicker? The unemployment rate fell to 4.1%, when most were bracing for a rise to 4.3%. Markets had been pricing in a July rate cut with growing confidence. That's now been completely repriced. The probability of a cut this month? Effectively zero. And even the September meeting is now in doubt. Yields on the 2-year Treasury spiked by 12 basis points at one stage. The message from the bond market was clear. This labor market is not ready for rate cuts.
But wasn't there more nuance beneath the surface? I mean, are all those jobs really a sign of strength?
That's exactly where it gets interesting. About half the job gains came from the public sector, especially education. Private sector job creation was far less robust, around 74,000. Construction and manufacturing were flattish. Retail and tech? Almost nothing. And then there's the participation rate. It slipped again. What's even more concerning is that foreign-born worker participation is trending lower. Combine that with a graying population and restrictive immigration policy, and you're staring at a structural headwind for future U.S. growth.
That links to another big story this week, the so-called Big Beautiful Bill. What are the implications?
It passed. And buried in the fine print is a massive 13-fold increase in funding to ICE. The U.S.-Mexico border gets over $46 billion. That may score political points, but from an economic perspective, the message is this. The U.S. is doubling down on migration controls. Now, pair that with falling foreign-born labor participation, and you've got a looming supply-side issue. The labor market might be tight now, but 5 years out, you could see a real squeeze on growth and productivity. The jobs report might be strong today, but the long-term path just got narrower.
How did markets take all this in? Was it all doom and gloom in equities too?
Actually, no. The equity reaction was mixed. Rate-sensitive sectors like real estate and utilities pulled back, which makes sense with yields rising. But broader indices? They held firm, even staged a modest rally. That's because investors took a different cue. The U.S. economy is still expanding, and if we're not staring down the barrel of a recession, maybe earnings won't collapse after all. That provided some support to names outside of tech, especially in cyclicals and small caps.
And what about the ADP report from earlier in the week? That painted a completely different picture.
Exactly, and that's part of the confusion. The ADP private payrolls number actually showed a decline of 33,000 jobs, a total reversal from expectations. It set the market up for a bond-friendly NFP report. And then, the exact opposite happened. So now the narrative is muddied. Are we decelerating? Or just fine? The Fed is probably scratching its head like the rest of us. But for now, they've been given a stay of execution. They can wait. And with inflation still sticky and tariffs slowly feeding through, waiting probably feels like the safest option.
Speaking of tariffs, President Trump hinted again at unilateral actions. What are we watching there?
Yes. Overnight, he threatened to invoke unilateral tariffs unless deals are struck by next week. Japan, Korea, and the EU are still negotiating. We are now in a window where anything could happen. The Vietnam deal is a perfect example. U.S. goods get tariff-free access into Vietnam. Great. But on the flip side, Vietnamese exports into the U.S. now face a 20% levy and a whopping 40% if those goods originated in China. That's not good news for American consumers, and certainly not for inflation.
That's it for this week. Stay tuned for more insights next time.